I believe that over 10 years, the US dollar loses 75% of its purchasing power.
Yep.
If it does that, I would expect that gold would maintain its purchasing power, which means that over 10 years, I see gold in nominal terms between 3 and 4 times higher than today. In prior bull markets, once the crossover has occurred, once silver begins to outperform gold, the performance in silver is roughly double the price of gold. I'm not saying to you that silver is going to go 8-1. What I am saying is that a move higher in silver, from my point of view, is statistically extremely probable. I would be surprised over a 10-year period if the gold price wasn't measured in 5 as opposed to 4 digits.
Where's the high price for gold? Probably, $8,000 an ounce. I would be thinking, I think I better sell now at that sort of level, which is a 2x from here, double. Yeah. But silver, you look at silver, and it could easily go to $100 an ounce. And again, there's old pilots and bold pilots, but not many old bold pilots.
In a recent discussion, veteran resource investor rickrule and market analyst Clem Chambers outlined a powerful long-term case for gold and silver. Their outlook focuses on one central idea: if the US dollar continues losing purchasing power at its historical pace, roughly 75% over 10 years, then precious metals are positioned for an explosive move higher. Gold has a centuries-long track record of preserving value. If inflation continues eroding the dollar, gold's nominal price would need to rise 3 to 4 times just to maintain purchasing power. Historically, once gold begins a sustained bull market, silver tends to outperform. Past cycles show that when silver gains momentum, its upside often doubles gold's percentage move. While no one is predicting extreme ratios, the probability of silver moving significantly higher is statistically strong. Over a decade-long horizon, the expectation is that gold could shift from 4-digit to 5-digit territory, with potential highs around $8,000 per ounce. At that level, many investors would consider taking profits. Silver, meanwhile, could revisit the $100 range during an aggressive bull phase. As the old saying goes, there are old pilots and bold pilots, but not many old bold pilots. A reminder that timing matters in volatile markets like precious metals. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview.
My experience has been that precious metals bull markets are established by gold. It's the fear buyer.
Yeah.
And when the momentum in the gold price attracts generalist investors to the space,
Yep.
market leadership changes from gold to silver. This will be the 4th time in my life that this occurred. It looks like in the market that transfer is taking place as we speak. Whether or not that's true, of course, time will tell. When leadership transition does take place, silver outperforms gold pretty dramatically. And the high-quality silver stocks outperform any other extractive asset class I know. I hope you paid attention to the part where I said high quality, though.
Yeah.
There are a lot of purported silver companies that litter the speculative landscape, who unfortunately have no silver, and they're going to see that. It's important to note that most of the real silver companies are gold companies in drag. More than half of their revenues are gold, but they're still extraordinarily leveraged to silver. It's important to note too that while gold is not merely at nominal all-time highs, but probably in constant dollar all-time highs, silver is far from an all-time high. $57 comparing to 50 forgets the fact that 15 years has passed since the last time they were 50. If your tactics are different than your strategy, you're going to lose money. In this business, you have to be very patient and you have to be very tenacious. You will have, at some point in time in this gold bull market, you will have a 20 or 25% or even 50% decline in the gold price. You will have that. Every gold bull market that I have ever participated in my life had more than one 25% decline. If you aren't psychologically and financially prepared to weather that, you can be right about gold in 10 years and still lose all your money in 3.
The number that I keep thinking about is that they make 3,200 tons of gold every year. They make 25,000 tons of silver every year. That's only 8 times. Yeah. So, if that ratio of 80-1, which it likes to seem to hang around at 100-1 when it's out of fashion, could easily go down to 40-1, and gold could easily double. So that's a quadruple. So from here, you could be looking at 150, 160. That's a stretch, a big stretch, but I don't think 80 is a stretch at all. And I don't think 100 is, 100's getting a little spicy. Gold is really just a thermostat of geopolitical stress, because it is the currency of conflict. Yeah, if you get into a punch up at any scale at all, people, particularly if you're losing that conflict, people won't take your paper, won't take your bonds, won't take your promises. They'll just take gold. And that's the same for everybody. And, ultimately that applies to all countries. The fast horse is silver, which is a retail reaction to them. So, they're chipping away at it. They're chipping away at it. They're not going to stop chipping away with it. And at some point, whoever's bringing it in will say, "Oh, we're running a bit low." And that demand will just push the price. And that's what's pushing the price. And, people go, "Oh, don't say that about gold is for war." Well, who's buying it? Who's the big buyer? China. Why would they be buying it? They've got loads of gold mines, they say, "Oh, well, they don't want to have the dollar." Well, they probably haven't had the dollar for a long time. If I'm a country and I've got $500 billion of US dollars, okay, I just ring up an investment bank and say, "Yeah, hedge that for me, will you?" And they go, "Yeah, sure. It takes a few days." Hedged. So that means I don't have it anymore. I might have it in my drawer. It's I've got $500 billion. Yeah, no, it's gone. It's all hedged. Yeah. So, they don't have to sell dollars to get gold to protect themselves from the dollar, but they want gold, because you can't magic gold out of thin air. "Hey, we'd like you to pay for these raw materials in gold, please." "Oh, okay. Will you take a little letter that says I owe you?" "No." "Would you put it on a battleship and sail it over, please?" "Oh, okay." That's how they used to do it in the Second World War, submarines or battleships. Yeah. And because gold is the currency of war. And we all know, you don't have to be a genius to know that global stress is going up and up and up and up and up. Now, if it pauses or people get distracted, nothing ever goes up in a straight line. It's pausing, it's repriced, and then someone will shout at somebody and it'll go, boom. Or someone will have a meeting and say, "Yeah, this 1,700 tons of gold we got, I think we need 2,000 or whatever." And they go, "Yeah, okay, boss, we'll buy 10 tons tomorrow, and we'll buy another 10 tons on Friday, and we'll buy another 10 tons on Monday." And suddenly goes, and that's what's been going on. It is central bank, as if that's anything to do with money supply. It is government central strategic asset purchases that's doing this. And is there any reason that should go into reverse? No.
In the latest discussion featuring respected resource investor rickrule and market strategist Clem Chambers, a powerful theme emerges. Precious metals bull markets begin with gold, but they are ultimately driven by silver. According to Rule, every major precious metals cycle he has witnessed started with fear-based gold buying. As gold rises and momentum draws generalist investors, leadership consistently shifts to silver, often producing dramatic outperformance. Rule notes this may now be happening for the fourth time in his career. Historically, once silver takes charge, high-quality silver equities become some of the strongest performers in the entire resource sector. But Rule stresses a warning. Many so-called silver companies have little real silver exposure, while the true silver leaders often earn more than half their revenue from gold, yet remain extremely leveraged to silver's upside. Compared to gold's near all-time highs, silver remains deeply undervalued. Its last major peak near $50 occurred 15 years ago, meaning inflation-adjusted highs are far above current levels, with annual production at roughly 3,200 tons of gold versus 25,000 tons of silver, an 8-by-1 supply ratio. The current market ratio near 80-by-1 appears severely stretched. A move toward 40-by-1, even with gold only doubling, implies the possibility of silver quadrupling. Chambers emphasizes gold's role as the currency of conflict, a strategic asset accumulated by nations preparing for geopolitical tension. With central banks buying relentlessly and global stress steadily rising, neither expert sees a reversal in demand. Volatility will come, including 20-50% corrections, but the long-term setup remains powerful. Now let's get into the interview.
I think Intel is going to be doing exceptionally well. It's got another 50% easy in it next year. Maybe 100% even. When I started to tell everybody about it at $20, it's doubled since then, and it's made me very happy. But I think it's got $60 in it quite easily. And if you look at those chip people, it's 3 times sales is Intel. Okay. If you look at Nvidia, it's 65 times sale. AMD's whatever it's 20 times sale, 30 times sale. Broadcom, blah 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 blah. You go look at the sales multiples. So Intel could easily be 10x. Now you can say Intel's a shaggy dog and what a load of rubbish. But if you actually listen back to President Trump and the Secretary of War, etc., etc., They're talking about onshoring. Well, AI, who makes AI? You might say NVIDIA makes it, but who makes their boxes that do it? Well, it's all done in Taiwan or China. That's not so good. How about all the other people? Taiwan, China. Who's got fabs in America? Oh, all those people, they sold their fabs. They said they didn't want it. That was dirty business. They just wanted to do the clever stuff. And that's all the dirty stuff's going to be made in Taiwan and China. What dirty stuff like Intel do? Yeah. Intel's the only people with fabs in America, really. Oh, how sad that is. Oh, and what about Europe? What have they got in the way of fabs? Oh, they're all Intel as well, give or take. Okay. And now they've all got to onshore it into America, haven't they? Because if you're making your stuff in Taiwan and they cut that cord, you're toast. So how long does it take to make a fab? 3, 4, 5 years, bit like a copper mine. Okay. So who got fabs? Intel. Oh, and they're cheapest chips. Yep, or literally cheapest chips. So Intel is basically, that's why the American government came in and said, yes, 10% please, thank you, investment, ka-ching. Yeah, because they've got the fabs. Without the fabs, what are you going to do for chips? All your rockets that can't fly now because they haven't got chips. All your planes that can't fly, and all your GPSs and all that magical technology that's meant to put you in front of everybody. Somebody else over far, far away is making them all. So who can make them in America? Right now, the 800-pound gorilla of fabs in Europe and America is Intel. And that's why the American government has invested.
In a rapidly shifting semiconductor landscape, Intel is emerging as one of the most strategically positioned companies in the world. While many investors have focused on NVIDIA, AMD, and Broadcom, often trading at sky-high sales multiples, Intel remains deeply discounted by comparison. Yet the long-term fundamentals now favor Intel in ways the market is only beginning to acknowledge. With the U.S. government pushing aggressively for onshoring of critical chip manufacturing, Intel holds a unique advantage. It operates the largest network of advanced semiconductor fabs in the United States and Europe. When geopolitical tension threatens supply lines, companies dependent on Taiwan or China face enormous risk. Intel, on the other hand, becomes the irreplaceable fallback, the only large-scale manufacturer capable of producing the dirty work of high-volume chip fabrication domestically. As global AI expansion accelerates, demand for secure local fabrication becomes unavoidable. Fabs take years to build, and competitors outsourced manufacturing long ago. That leaves Intel as the 800-pound gorilla, positioned to capture government support, defense contracts, and corporate onshoring initiatives. If valuation multiples merely realign with industry averages, the upside could be substantial. With geopolitical pressure rising and fabrication shifting back to American soil, Intel may be entering a powerful multi-year growth cycle. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.